What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online, as usual. So today, I'm going to talk about a concept I think we hear about a lot, um, which is highest and best use, and how that applies, to investment properties. But also, I'm going to talk a little bit about what I think some people sometimes miss when we talk about it. I notice it a lot in residential appraisals. It's something that's not talked about a whole bunch. Um, One thing, I know I cover a lot of different topics on here. I'm sure I come across as a know-it-all quite a bit. I have been in this industry a very long time, but especially early on, I did a lot of different jobs. So I actually worked in appraisal for a while. I worked for this company here, Deloitte, in their Deloitte FAS. They have a commercial consulting or commercial real estate consulting group. But a big part of what we did there is work on evaluations or valuations and appraisals. I never actually became a full appraiser. I was only there a short time. I had my appraisal trainee license in Texas, but it seemed like nobody really cared. Like, I mean, they just, you'd work on something, you'd put it out, and then one of the other appraisers would review it and they'd put their name on it. So I did, I banged out quite a few commercial appraisals in the time I was there. It just wasn't technically my appraisal. It was, whoever had to review it and put their name on it. So I have but I have that type of experience in a lot of different parts of real estate where I got a job. This was in like the 2006 to 2012 timeframe, where there was just a lot of, most actually really started mostly in 2007 and 8, but there was a lot of turmoil, especially in the commercial side. It happened a little earlier. A lot of people don't realize that. But like August of 2007 is when we really, capital markets froze on us for the first time. Things got pretty scary. Um, but anyway, I ended up changing jobs like I think 9 times during that period of time, and got to have like that first 6 months type of experience at a lot of different things. And so which basically is just a way of saying, I have very wide experience, not necessarily super deep in a lot of this stuff. So, as far as talking about the concepts of highest and best use and how it applies to what we're doing, I feel pretty confident now. There's a whole bunch of technical aspects of that industry where I couldn't write an appraisal today. I could, I wouldn't come close to doing one that was compliant or looked good or anything, because the only stuff that I've kept with me over the years in my brain is the stuff that I feel like still applies to what I'm doing today. But one of the things I had pulled up this company because I was trying to figure out if anybody uh, that I used to work with is still there, and I realized they have some great articles out. They actually have a recent one about tokenization. This is a weird aside, right? But so I posted this in the Discord. Um, which is a good time to stop and say, please like and subscribe. If you haven't already, please join us in the Discord. There's about 40 to 50 of us that are talking about, fractional real estate investing on a regular basis. So that link is in the description to this video. There's also links to all the places where I'm currently investing in fractional real estate. Do your own due diligence. Just because I buy on a particular site doesn't mean that you should. Just because I buy a certain property doesn't mean you should, right? You want to dig into these things yourself. I'm just trying to share some of my experience, in some of the different ways of looking at these deals. And that's what we're going to do today. So let's jump into it. So one of the things we always see is this highest and best use, right? It should be in every appraisal, or I think it should be. This is like the what is this? Uniform Real Estate Appraisal Report, something like that is what the URAR stands for. Um, but you'll see it every time. And so what are they really talking about? Like, just looking, Wikipedia actually does a pretty good job of describing it. They're just basically saying, like, if we just could do whatever with this property, what's going to be the high, well, and these are the things, right? It's got to be something that's legally permissible, meaning the zoning allows it, building code allows it, that sort of thing. And even local ordinances related to like what you can sell or what type of businesses you can have. All those things have to allow it. Physically possible. So if it's swampland, maybe not. Physically possible is a tough one because sometimes it ties tightly, very closely to financially feasible. Because, for example, I was going to say, well, you can't build a high rise on swampland. And, well, actually, you probably can. It's just going to cost a ton of money. And so financially feasible is the next one. But then the one that's most important, I think, the one that really, comes into play is maximally productive. It comes into play in what the way we're thinking about properties a lot, I think. And so that means it's the use that's going to make the most money to whoever buys the property. And it's not just as us as owners or someone else's. It's you take everybody in the marketplace out there, and whoever, the marginal buyer, the person who's willing to spend the most money on that property, what's the most money they're going to make on that property, right? I mean, that's sort of the way to think about maximally productive. And so one of the things that, when we look at these appraisals, this is basically saying, okay, there's deed restrictions. It's got to be single family residential, which is interesting because we do have two units here, right? But one of them is it an ADU? Is it a second unit? Is it just a separate living space in the same unit? That's actually a discussion for a different day. But so they're talking about it can really only be residential, so that's what you have to use it as. The current usage, there's plenty of life left in the improvement, so that should be what we do. One of the things that they look at is like, well, if there wasn't, right, if the property is pretty dilapidated, maybe tearing it down and building something different is something that we always have to consider. And so, but you'll notice there's no discussion on, is it, what's the best use? Should it be short-term rental? Should it be long-term rental? Should it be month to month, renting by the bedroom? Um, that sort of discussion happens in commercial appraisals, because it is, that sort of thing is really, commercial appraisals are driven by the income of the property, where on the other side, residential appraisals tend to focus on the sales comparison approach, right? And that's because most of that market is driven by owner occupants. And so most of the market that's buying homes, they're not considering the money it will actually spit out. They're just considering, I want to use it. And so some people use this term use rent, right? Like, what are they willing to spend to use it, even though it's not really, nobody would, you're not going to be able to rent the property for that, but you have somebody willing to buy the property and pay more to be the user of that and the owner. And so this is something that you never really see talked about in residential appraisals, but it's something that we really need to think about when we're thinking about properties like this. And so this topic came up because I was talking to some people in the Discord. We've been trying to sell this property. Um, One of the things that I've mentioned many times is I just don't think it's really suitable for an investment property, right? I think that the things that we've tried to do so far haven't created very much revenue. As a long-term rental, it doesn't. The short-term rental seems like it's not allowed. As a mid-term rental, it's barely broken even, right? Like it has a very hard time carrying itself as a property, and it's because the value of that property is very high. When we've gotten quotes even to sell it to Open Door, which is just an iBuyer, or basically, acting as just giving us a cash offer, which you tend to expect to be your lowest possible offers. And it looks like they're going to be somewhere in the high $30 range, right? Well, people haven't been willing to pay that, for a while for this property on a token basis, right? But so the token, the net token price looks like maybe it's going to be in the high 30s. But like looking at it, probably if we sold this, if we took the time, we used an agent, we sold it, on the market, fixed up any little things that we needed to, there's a good chance it's worth even significantly more than that, right? We could sell it for, who knows, maybe as high as $45 a token, something like that. But that's because that end buyer is most likely going to be an owner occupant. It's not somebody who's going to use it to, as an investment. And so this is really lost on, when you see this highest and best use discussion in residential appraisals. But like when we would do this for apartment complexes, we would do this analysis all the time where we look at is this worth more as an apartment where people are renting it, or is it worth more as condos where we sell them off? And a lot of people don't necessarily realize this, but there's often zero physical difference between an apartment and a condo, right? You can take a apartment building, do some paperwork, and all of a sudden you have separate condos, and then you can sell them. And so, determining whether something's worth more as a rental or for sale product happens all the time on the residential side or on the commercial side. And even like, developers like, should I build to rent or should I build to sell? That analysis happens all the time. But when we're looking at these highest and best use analysis that we see in residential appraisals, they're almost always kind of a throwaway. They're like, oh, it's zoned residential use. That's what it should be. They're not differentiating between um, what it's worth for to which type of residential use makes it worth the most, right? Short-term rental, long-term rental, rent by the room. But that's something us as investors really need to consider, because you've heard me talk about this a lot of times where I basically say like we should just sell this property, because I don't believe the token price is ever going to get to what the real world asset price is. And I think that when I say that, it doesn't click with people. But what I'm basically saying is the highest and best use for this property is not as an investment property. It's as somebody that purchased it and live in it as an owner occupant. And the reason that is because there's different ways to value. And if you look at this was a pretty decent article from Investopedia a couple months back, but it's 5 ways to value your real estate rental property. This is number one, right? Residential or sales comparison approach. This is the number one way that residential real estate is valued. Even in these, and this is the appraisal for Odom that I'm looking at. Even in these appraisals, we'll always see that they're doing a sales comparison approach. I mean, that's going to be the number one approach that they'll use. They might do they have a cost approach that they'll do sometimes. They'll do an income approach that they do sometimes. But for residential appraisals, for single family homes specifically, not, when you get to larger multi, it's not the case. But they're almost always just looking at sales comps, and that's how they're pricing it. Even if they do the analysis for the other stuff, they're usually giving the most weight to your sales comparison approach. But us as investors, sorry about that, just had a little technical issue. But what I was just saying, the residential appraisals focus on the sales comparison approach, but us as an investor should really be focused on some other types of approaches. If you haven't, this was a pretty good article that came out recently on Investopedia, just talking about different ways to value real estate rental properties. Obviously, they start with the sales comparison approach because that is the dominant way that residential properties are valued. But they also talk about the capital asset pricing model, which I think is important, the income approach, the gross rent multiplier approach, the cost approach. And so I'm going to just cover these really quickly. A couple of them, just give you a couple sentences because I think they're not super important to what we're talking about today. Cost approach is really just what would it cost to rebuild this today? We take the land value, we take the whatever the construction costs are, and then usually we also apply some depreciation to get it to, because the property is not brand new, we have to depreciate that value a little bit, and that's what we get today. The gross rent multiplier approach is, hear this a lot on Bigger Pockets when people are talking about the 1% rule. They're actually using a gross rent multiplier concept. They're just using the inverse of how this is calculated. And so like a gross rent multiplier, you take the annual rent, the gross annual rent, you take the property price divided by the gross annual rent, and that's how you get your multiplier. Or said the other way, you find the market multiplier, whatever it is, you multiply it by your gross annual rent, and that's how you would come up with a market price. Where versus like if you have heard of the 1% rule, they're really taking a monthly rent. They're taking a monthly rent and dividing it by the the price, or you divide it by 1%, and it should give you the value of the property, right? And so gross rent multiplier, just an inverse of that, but you could use either way. as long as you're using it to just compare across properties. I think it's a great way to look at properties, to do your initial comparison. It ends up breaking down when the expenses are wildly different from one property to the next. But especially for single family homes where people aren't really, you can't necessarily access a lot of the expense data that people have. It's a pretty useful tool, and which is why you hear people talk about it a lot. The income approach, this is how most, this is the main way when you're doing commercial appraisals. People are looking at the income approach. They're taking, you're calculating what the NOI is, what this, usually they're looking at like stabilized NOI for that property. And then I'm not going to go too deep into it, but so you're just taking the NOI, you're dividing it by the cap rate. Um, and that should give you the expected value. And I think so. I mean, this is one of the ways I think that we should be looking at. It's kind of like what we're doing when we're pricing tokens, right? Is we're okay. What are we going to get for income from this property? Um, that it's it's how it appears most people are looking at it when they're just looking at the yields of the tokens. Now, I think that there's a lot of people that are not properly, they're taking too much for granted when they're doing that, because like a lot of people, you can tell the market's moving based on last month's versus like what is this going to be as a stabilized, going forward income. But it's similar to how I think some people are looking at um, the tokens on Lofty. But I think it's more, at least if you're really serious about the way you're investing, your approach should look a little bit more like, this capital asset pricing model, which is basically, um, you know, looking at what your ROI is, uh, but also on a risk adjusted basis, right? And so like comparing it to other investments that we can potentially have, comparing it to, even things as much as, as comparing it to REITs or treasury bonds. Now, I'm not really going into this type of analysis when I'm looking at tokens, because I've decided, I've I am a real estate investor. It's what I understand. And so, because of that, I think that I have an advantage in the real estate space. And so, even if potentially I could get better risk adjusted returns buying certain REITs, I'm not knowledgeable enough in that space to be able to do that. But in any case, looking at the income that's going to be derived from it, looking at, the basically thinking of sort of a discounted cash flow analysis where I'm going to get X amount per, from the tokens regularly from my rent. And then at some point in time, have a sale, and what does that look like, and comparing the risk. When I'm thinking about these deals in that sort of a way, looking at it like that, or looking at it, with as an actual investment property, that's when this particular property and a lot of properties on the platform really fall down, because um it is, the implied price at the current token price of $33 is, well, let's do the math on that, right? So like 33.52 times the total tokens, 11,877. It's basically implying a value to the property of under 400,000, where, when this was sold, it was around 600,000. House Canary thinks it's even a little bit higher. Um, I think if we listed it for sale, we probably don't net 600,000 today. This was basically purchased at the peak. I think there's a little dip since then, and then I don't really think we've had any appreciation. So, looking at the estimates that we got from agents, maybe we can sell it for 500, 525, 550. I don't even think 600 is really realistic. Um, but regardless, like let's say it's 600, and so that's, or what does it have to be? Is that, let's see, is that 5167 times 11,877? Yeah, that's what gets us that 613. But so what if we just do 11,877 times 50? Yeah, so that's, yeah, initial purchase somewhere around there, right? Uh, let's look at though. Let's say we sold it for 550,000. Divided by 11, 877, and net. Let's say we net 550,000 after fees and everything. Okay, we're getting $46 a token. Well, at the moment, the lofty market has decided this is worth $33.52 per token. That's it. It is an inefficient market. Like I'll definitely grant that. But it's been at this, this price or lower for a while. I think I started buying this at like $35. But my average token is now somewhere around 29, uh, either 28 or 29 and change. Um, but I think that, if you compare that, okay, so if we did sell it and we were able to, get a market value or market price and end up with 45 or $46, that's a big improvement from this price. Um, but there's a discussion like, well, what if we just, get it live again, maybe put some debt on it, pay off, pay out something to the investors and then have this higher yield. And I think where that kind of falls apart is if we're looking, thinking about this capital asset pricing model type of analysis where we're thinking about, okay, where are we going to get the best ROI? Where are we going to get a better risk adjusted return? If right now, let's say I can only get $40 per token, right? If I are there places I could take that $40 and go and get a better return than I'm going to get by holding on to this and trying to get this going again? And I think the answer is just very clearly yes. When you look at the amount of revenue that we just haven't produced a lot of revenue relative to the price of this property. And again, I think it goes back to the fact that the highest and best use for this property is probably an owner occupant, right? It's just not, we can't use it as a short term rental. Uh, midterm rentals have just proven to not to bring in a ton of income compared to the price of the home. And I think long-term rentals were equally problematic, right? And so when we're having that, when we're making that thought process and trying to figure out should we sell this or not, um, even though maybe the market price of this, let's say the market price is 600,000 or 593, well then that would imply that this should be a $50 token. But because I'm thinking about this as an investment, it might be worth $50 on a sales comparison approach whenever we go to sell it. But because I'm getting a below average yield when you compare it to other properties on Lofty, then I'm going to get then I need to buy it at a lower price than what we're going to eventually sell it for per token, right? And that is where that sort of understanding of the value of the token, the value of the property as an investment versus the market value of the property are very different things. And it's why, so in my day job, I help people buy investment properties here in San Antonio, Texas. I really don't help anybody anymore. Now my team does, and I just sort of deal with problems. But, there's at any given time, there's 10,000 properties listed on our MLS. And if we find five in a month of those 10,000 that I think are going to be a great investment for clients, I'm really excited about that. Five out of 10,000, right? Like that's a ridiculously low number. And it's because, if I'm looking for a great investment property, and I'm buying from the MLS, which is what my team primarily does, well, then it's difficult to find something where you can pay market price but also have a great investment return, right? And so that's why one of the reasons that properties will struggle on Lofty, if you can't find that right balance, right? You have to find one that they can bring to the platform, not at a discount, because otherwise the co-owner who brings it is going to lose money. So they have to be able to bring it at market price, or in many cases higher, but also be able to produce an outsized return. Um, whether or not that's a sustainable model long term, I think is going to be interesting. That's one of the reasons why I've definitely blabbed about that too much. We'll talk about that in another video where I mentioned it briefly, where I think that the model needs to become an acquisition funding model for it to really aligned co-owners with the other investors in these properties, to where by going out and finding the good deals and purchasing them together, you don't have that sort of conflicting interests as far as like the price that it gets brought to the platform. Where the investors want it lower and the co-owner wants it higher. If you do it as part of an acquisition, then you can see how that how they could match up a little bit more. But anyway, that's an aside. I guess you've probably come to expect like a lot of tangents and asides from me. So that's just the way. I don't think it's obviously not as organized as it should be up here, but hopefully some of this info is coming across as useful, right? And so that the whole point is just, well, I guess I had a couple of different points, right? One, I wanted to just dig into what is this idea of highest and best use a little bit, because I think it does just really get thrown away when we look at it in the appraisal, because appraisers, especially when they're doing residential appraisals, they're just knocking these things out. I would bet that very less than 2 minutes was spent thinking about this highest and best use. They did have to actually talk about that it was deed restricted in this area, but for most single family homes, it's probably either that or they say something about the zoning only allows this, right? And so then it's the only legal permissible use, and there's nothing wrong with the property, so that's what we think, right? Where really, if we're thinking about it from an investment perspective, I think we need to add a little bit of nuance in what that highest and best use is. And then, as part of that thought process, we have to think about, well, how are we valuing our investment properties? Um, and then we just sort of have this, we have a difference in the way we're going to value that property versus as an investment versus how the market's going to value it, because the typical purchaser in the market is going to be an owner occupant. So that's all I really wanted to talk about. That I wanted to just mention this again, right? Like they do have a lot of really good articles here. I was trying to figure out if anybody is still there from when I worked there, and I couldn't find us. I found one guy, so I was glad to see somebody was still there. It made me feel like not that old. I think if everybody was gone, it was going to be almost depressing. But one guy was there that I know, so that's kind of nice. But it is an interesting free resource. Oh, I posted this in the Discord. I think I already mentioned this, but it's really interesting to me, um, that Deloitte, being who they are, is talking about tokenized real estate. Uh, it makes me really optimistic about the space, right? I mean, they're the largest financial services company in the world, or yeah, I think that's true. At least it used to be true when I worked there. And they if they're taking time to think about this, and they don't put out a ton of articles, so if they're taking time to think about this, um, let's see how many they have. Yeah, I mean, this is their 2025 outlook. So, I mean, they've only had a couple since then, and this is one of them. So, I think if they're thinking about it, I think we're all in the right space thinking about, fractional real estate investing right now. We're definitely getting that first mover advantage, but also, we're in a spot where we're having to deal with lots of uncertainty as well. I don't know about you. So far, I'm really happy with the returns I'm getting. This will be a big one for me if we do sell it, or if somehow we figure out a way to make money with it. I'm okay with it. I just I want to figure out what's going to give me the highest return. And one last thing, and I think I've talked about this before, but some of the people are thinking, well, I paid $50 for this versus you paid 29, but it's still, from this point that we're standing in going forward, our profitability is exactly the same, right? We're all holding the same asset. And so what's the most profitable solution for each of us should be the same regardless of what we spent, right? Because we're ignoring the sunk cost fallacy. The only difference is if we have different, future holding periods, outlooks, like if we're going to need that capital sooner versus later, that might change things, and our tax position might change which strategy is going to work best for us. But in general, we're all basically in the same boat. We're all sitting on tokens that we could sell for $33 if we wanted to. We could liquidate the property and get, whatever we get. Or, so the fact that some of us it's a loss and some of it's a gain, from this point moving forward, I think that our interests are aligned. So I know that gets brought up a lot, and I just wanted to mention that I don't really believe that it puts us in different positions when thinking about. The only difference is psychologically taking a loss versus having a gain might be different, right? But it is not. Um, what's the most profitable use of our token that we're holding right now moving forward? I think is not. I think we're all in the same boat, right? That's all I want to say about that. Anyway, that's going to be the whole video, I think. Is this annoying anybody else, or is it just me? So, I got the new mic. I think it's working. It sounds a lot better when I listen back to it. But it is kind of weird looking. Like, I don't know. I might be able to adjust it or something, but it does block my vision a tiny bit. But I'm sure that probably you don't even look at this little picture on the side, right? Hopefully, you're just looking at whatever I'm doing here. I only put my face on here because I always think it's weird when people talk to me on the video and I have no idea what they look like. So, but yeah, I'm sure you don't spend a lot of time looking at me in my Naruto shirt over there. Anyway, until next time, I'm going to just keep making mistakes so that you don't have to.